Okay, noble colleagues, before we went on break, we have discussed backgrounds, and in our backgrounds, we have discussed the definition of plants and machinery. We discussed definition of some key concepts, name of the meaning of plants, meaning of machinery, equipment, charter. We equally look at constituents of plants and machinery. And again, we have looked at factors affecting the value of plant and machinery. So now, we want to look at purposes, basis of plant and machinery valuation now. Plant and machinery valuation. What are the purposes for which plant and machinery are being valued? What are the basis of all these valuations? As a way of introduction, let me first of all mention that there is no special difference between the purposes of valuation in land and building and the purposes of valuation in plant and machinery. The only difference is the classification, categorization, which a body of knowledge has done for us before now. So basically, all what we have in terms of purposes of valuation in land and building, we have them in plant and machinery. Substantially, almost all of them. Okay? But in plant and valuation, we have special way of classifying or categorizing them. And for the purpose of the exam, I will expect the candidates to classify or categorize them in discussing them, so that it will have the face of the body of knowledge in plant and machinery. Without categorizing does not mean you are not answering your question. But when you even categorize, you'll be able to dwell more. You know, at least you have section by section to write on. Now, before I hit the ground running, talking about the different categories, it's important for us to discuss what is what is the meaning of purpose of valuation. What does it mean to us? Purpose of valuation. Excuse me. Purpose of valuation. This word, purposes. What does it mean? Purpose of valuation. Purpose of valuation is an expression of client's requirements for the valuation. It is an expression of the objective for which the valuation is required. Why does the client need the valuation? That is purpose of valuation. Okay, so every valuation will be required for a purpose, right? And it's important to ascertain that purpose because it's very, very close to wanting to treat a patient. You need to know, to diagnose what type of sickness is the person is with. So purpose of valuation, confirming it in accepting valuation instruction is very important. We need to know why the client needs the valuation. The reason for that is what we call purpose of valuation. An expression of client's objective for the valuation exercise. That's very, very important because it's going to, one, prescribe or determine what will be the basis of valuation. And in some ways, will dictate what methods will be used or what are other relevant data that will be very, very important. So, having given background to what purpose of valuation is, then what is basis of valuation? Basis of valuation, simpler, in single form, when you talk about the single form of basis of valuation, you are saying basis. Okay, basis of valuation. Basis of valuation here It's not talking about the premise. So a lot of people say the premise or assumptions behind valuation. No, yes, it will affect, it will bring forth what premise of valuation will be. But basis of valuation itself is an expression of value concepts. Value concepts. It's an expression of value concepts. Okay? Basis of valuation is an expression of value concepts. Value concepts. Okay? Now, talking about basis of valuation, therefore, we are talking about what type of value do you need? What is the nature of the value that is required? Okay? The value that is required. And this will be prescribed by the purpose. Is the purpose that will give us what the basis is. Different purposes with different bases. That's why it's important to ascertain the purpose of the valuation so as to know what basis, what value concept will answer the need of that purpose of valuation. What value concept will meet the need of that value of valuation. It's like prescribing drug for a particular sickness. So, basis of valuation is an expression of value concepts, the nature of value that is required to satisfy the need of the clients. So, noble colleagues, having said that, that's good enough as background. Then, I take to mean that with this, we understand that it's different from method of valuation. Basis of valuation and method of valuation are not the same, right? So now, let's pick what are the purposes of valuation in plant and machinery valuation. We have three categories. Three categories. Okay, we have three categories. These categories cover what you see in my chart here. I have what we call the insurance category. We have what we call the financial, and on the final note, the open market valuation. So we have three categories. Chris Derris actually promoted this categorization, and it's of general acceptance. That means all purposes of valuation can be classified into three: under plants and machinery valuation, insurance, financial, and open market valuation. Now, let us see insurance. Insurance. The category of insurance purpose incidentally happen to be one single purpose category. The category of insurance valuation and purpose of valuation under plant and machinery is what? One single category. It's one single category. No other purpose of valuation is there. That's what it means. No other purpose of valuation is there. So it's only one purpose group. However, insurance valuation for insurance has two bases. That's what we should know. It has two bases. I need to bring this up here, even though I would have loved to discuss that under basis of valuation, but let me quickly explain. Insurance valuation can be for reinstatement and can be for indemnity basis. We are talking of basis here. Basis. Okay? Reinstatement and indemnity basis. Okay? Now, in a plain language for our understanding without cramming words, what reinstatement basis means, you are looking at a value in the nature of a new asset. Value of a new asset, a new typical asset or equivalent asset. A new typical or equivalent asset. The value of a new typical or equivalent asset. That is the reinstatement value. It then means that you are not reflecting the existing state of your own assets. And that is why they call it what? Old as new. this expression, valuing old as new. Our noble colleagues, a little gist here. If therefore, under write short notes on the following, you see an expression that says valuing old as new. You should know what that means. It's talking about what? Reinstatement basis. Having to value an asset as if it's a new asset without allowing for depreciation. You will not allow for what? Depreciation. That is reinstatement basis. That is reinstatement basis. And I said, in other words, this is value of new for old. Even though your the amount of value is old, you will give it value of a new asset. You will not reflect the existing state of it. You are not allowing for depreciation there. That is reinstatement basis of valuation for insurance. Now, valuing old as old, reflecting the existing state of the asset, is what we call what? Indemnity basis. That's what we call indemnity basis. That's what we call indemnity basis. Valuing old as old. That means we are reflecting what? The existing state of the asset. This one, indemnity basis. You see? Indemnity basis. That is it. Okay? So now, with this indemnity basis, what it means is that you are valuing old as old. You are valuing reflecting the existing state of the asset. You are valuing reflecting the existing state of the asset. What do we mean by reflecting the existing state? You do that by doing what? By making allowance for depreciation. You allow for depreciation. You allow for depreciation. Depreciation, therefore, relevance of it in valuation is to reflect existing state of assets. That's the relevance of it. It's one of your past questions, so, is to reflect existing state of asset, to account for loss in value that has happened because of usage, because of age, and what have you. Okay, so that is insurance purpose. I hope that is clear enough. Then we go to financial. Financial purpose is a group that classify all purposes under business valuation for business purpose, or any valuation that relates to business entity there, right, comes under financial. And there we have what we call the following. Let me pick my highlighter here on my pointer. The following here, you see, you have privatization, you have nationalization, you have merger and acquisition or takeover, you have flotation of shares. In the public sector, we call this one flotation of bond. Flotation of bond. In private sector is what? Flotation of shares. What I mean is that if it's a private sector organization asset, this purpose will be flotation of shares. But if it's a public sector organization, it's going to be what? Flotation of bond. They float bond. Then you have takeover, defense, you have investigation, taxation, you have a settlement of disputes, insolvency, balance sheets, right? Internal performance assessment and what have you. Like if you want to do financial planning, you use internal performance analysis to do financial planning. For example, you want to determine what asset could be sold off. You want to restructure your assets. That will call for internal performance analysis, right? You want to expand or you want to implement a kind of growth strategy. That will call for internal performance analysis, and so on and so forth. Okay, all these are what we have as part of financial, and all of them have basis. I'm going to explain the basis of each and every one of them as we proceed in the course of this lecture. So this is financial. Anything outside financial comes under what we call open market valuation. Anything that is not financial, it's not insurance, it's not financial, comes under open market valuation. So I give an example of valuation for sale, for example. I give an example of valuation for purchase and valuation for mortgage, right? All these example of open market valuation under purposes of valuation in what? In plant and machinery. Under purposes of valuation in plant and machinery. Okay. Then we will now go and see basis, but before that, let me quickly see. I don't know, maybe I've been leaving people behind. I have one says, okay, please, sir, refers back on reinstatement. Okay, I'll go back. The second one says, please mute your, okay, I think he's talking to one of the others that he should mute his microphone. Okay, good, thank you. So let's go back to reinstatement. And the person that I should reverse back. So I'm reversing back. Okay. Reinstatement now. The meaning of reinstatement, right? In a simple language, it means, the asset you want to value will be of age. For example, when you are using under reinstatement basis, you are not to reflect the existing state of that asset. You are not to value it rebel sinks tantimbos. That's the meaning. You are not to value it rebel sinks tantimbos. You are to value it as if it's a new asset. You have to value it as if it's a new asset. And that's why they call it value old as new. You give an old asset the value of a new asset. That's why you are not reflecting the existing state. You are not allowing for depreciation there. After getting your, for example, for plant and equipment, after getting your gross current reproduction or gross current replacement cost, which is what we call install cost new, after getting that, no depreciation. You are not depreciating. That is for reinstatement. Okay? And the logic is very simple. I didn't add that before. The logic is simple. Under reinstatement, the policy is such that, like, for example, if there is a problem with your car and it's covered by reinstatement and you have been meeting up with your obligation, that car, a new one will be given to you. Under reinstatement, there is no way for them to start reducing that car to its old state. When they buy a new one, it won't be feasible for them to reduce the new one to old state status. So that is the logic behind that. Now, when it is indemnity, you value based on the existing state of the asset. Please note, I am emphasizing what? Existing state of the asset, not existing use. When I get to the case of existing use, I will explain. Existing state of the asset, thank you, not existing use. Okay? So in this case, to value rebel sinks tantimbos in its existing state, as language implies, what do? You allow for depreciation. You reflect the existing state of the asset. You allow for depreciation by reflecting the existing state of the asset. Valuing rebel sink tantimbos. Valuing rebel sink tantimbos. Okay? But the logic behind that is simple too. In the case of this is a situation where they will repair the asset for the guy, for the insured. The asset will be repaired, or they give the cash equivalents, the fund equivalent of what? Of that of carrying out the repair. That is the indemnity. So you can see that the focus of the two, the perspectives are different. So I think that answers the concern of the candidate there. Okay. Okay, another guy say, please, if you have not muted your audio, please. Okay, it's talking to everyone. It's talking to everyone. Please mute your audio so that we can enjoy ourselves and without any distraction. Thank you. So now we are done with purposes. What therefore are the value concepts that will fulfill the need of each of the purposes? What is the value concept that will fulfill the need of each of the purposes? So I give you just a quick explanation here. I said the circumstances involved in each purpose of valuation prescribed the value concept, which has bearing on the need for the valuation. Okay? I think that is clear enough, right? Each valuation purpose, its purpose of valuation has its own peculiarity. It has its own circumstance. I call it transaction circumstance. It's the transaction circumstance that will determine what is the value concept that will fulfill the need of that valuation. Okay? Now, let's quickly look at the various value concepts that we have, various bases. I gave a summary. I summarized all these things in table here. If you recall, for insurance, we have said we have reinstatement basis or indemnity basis. You might have to do valuation that you will combine the two. You will declare reinstatement, you will declare indemnity. To be able to know whether you are declaring either of the two, you need to know the insurance policy. You need to seek clarification from your clients to know what is the nature of their policy. This is part of where accepting the brief becomes very, very important. In accepting the brief, you accept the brief with clarity. You clarify. Okay? So, please, it's very, very important. Now, before I go further, I see a chart here. When insurance valuation, you got the reinstatement value and indemnity value. Indemnity. Which of the value is the capital and which of the value do you use to calculate your personal fee? This person must have been chopping money in real estate services. Thank you so much. The first part of the question is that which of the indemnity or reinstatement basis, the value under indemnity or value under reinstatement is capital value? That's the first part of the question. Noble colleagues, both are capital value. Both are capital value. If you don't have capital value, you will have annual value. Indemnity can never be annual. Reinstatement is neither annual. They relate with the capital assets. They are lump sum, representing the cost of replacing or reproducing what? The assets. Representing the cost of replacing or reproducing the assets. If you are to replace and reproduce the assets for the insured in the state which it was before the eventuality, then that is indemnity. You are restating, you are putting him back into a state it was before the eventuality. Rebel sinks tantimbus, that is indemnity. But all new for old, that is reinstatement. Both are capital value. Now, the second leg of the question says, which one do you use to calculate your value? If I put it to you between indemnity and reinstatement, which one will be greater? Between you and I will take the greater one. Because if I'm not charging you for two fees, having to declare both in reinstatement and indemnity, I would rather say it's only rational for valuer to calculate his fee based on the greater one. You have delivered the two, actually. So pick the greater one, and the greater one will be what? Reinstatements. Because there you don't make deductions. Under indemnity, you make deductions for depreciation. Okay? Sorry. My coordinator said I should be careful. My coordinator said I should be careful. I should have myself with a bottle of water. But I said instead of having just ordinary water, I should be taking hot water, even though it's hot weather. Okay? Anyway, that's just by the way. Now, I think I answered that question appropriately. And I think that's so specific enough. So don't let's waste time on that. If you need further clarification, please don't hesitate. That's the essence of this interaction. Now, under financial, I've classified financial into two. I classify financial into what? Into two. In fact, I should break it up now with the trend in the society. Please permit me to break it up into 3 with the trend in the society. I will break it up now right there into 3, and I'll tell you why. Okay, now if the reason why I want to break it into 3 now is because of the fact that you know, today we now have what we call International Financial Reporting Standard. International Financial Reporting Standard. We have International Financial Reporting Standard, yeah, and we have International Public Sector Accounting Standard. Both have stated purpose of valuation, right? Both stated purpose of valuation. And for financial or accounting, let me split, sorry. 2, I think it's wrong. So that I can quickly give you the other one. Okay, I want to remove the one for balance sheet or financial reporting and make it and give it the appropriate value concept based on international financial reporting, which is trending now, so that we will not be living in the past. Okay, so for financial reporting, for financial reporting, it is what? Fair value. It is fair value financial reporting, and plant and machinery is part of the asset capture as part of a tangible asset under the standard. So it's fair value. Okay, thank you. Fair value. Now, under financial category, we have privatization, commercialization, full flotation of shares, merger, acquisition, and so on and so forth. All those ones that see business as a continuous process, that see business, that see the organization, that is like, it's calling for investment or value of the asset in a living business, a business that is still in operation. So it's looking at the value of the asset in that continuing business. Then the basis of it is what? Going concern. Or let me say the basis of all of them. Going concern basis. This is otherwise called existing use value. Noble colleagues, note that. When I was talking about having to reflect depreciation to show to arrive at indemnity, I said existing states value. Now I'm saying what? Existing use value. Going concern means existing use value. Existing use value means the value of an asset in a continuing business. That is going concern. So if you are talking of valuing a plant and equipment for merger, it will be going concern. For acquisition, nobody want to acquire dead dog, it's going concern. For flotation of shares or bond, going concern. Right? Privatization, commercialization, going concern. Okay? Now, when you are doing the valuation of a business asset for financial reporting, so I will take balance sheet off here. I'll take balance sheet off. That's financial reporting. For financial reporting, right? Then that is an example of a fair value in line with the international valuation standard, in line with international financial reporting standard. IVS 300 has that. That's international financial standard. IVS 300 has that. Then financial reporting standard has that. Okay. International financial reporting standard has that. So when you have all those ones, right, we are talking of a fair value for financial reporting. Fair value for financial reporting. Okay. Now, for insolvency or for liquidation, in which case you are saying that it's no more a continuing business. Then we are talking of gone concern. We are talking of gone concern. Another name for gone concern is alternative use value. Another name there is alternative use value. Just like going concern is what? Existing use value. Gone concern is alternative use value, right? And in that, we have apart from alternative use value as another name for gone concern, is equally called break-up value. Is equally called what? Break-up value. Is equally called up value. So let us know all these terminologies. That should be bonus if you have right short note on the following. And you can use all this to explain, to write your reports. Gone concern is alternative use value. What does that mean? You are looking at the value of that asset in an alternative utilization, not in that business anymore, not in the existing business. Alternative use, that's what it means. And it's usually of, item by item. Going concern valuation is a little complex. If truly you want to reflect the value of an asset on going concern, it has to be the value of the assets in the entity, that business entity. It's not going to be item by item. Now, when you are talking of insolvency or liquidation, asset can be sold in piecemeal, dismantled. Then you are talking of gone concern or break-up value, alternative use value. Okay, so then we have what we call for sale and for purchase. We have it as what? Open market value. Open market value. Open market value. When it is for sale or purchase, open market value. Again, we have for mortgage. For mortgage is either open market value or for sale value or combination of the two. It is common, however, that you have to declare the two in mortgage, and the reason is very, very clear, right? The reason is very, very clear. If you understand the circumstance behind mortgage transaction, it will show clearly the need for open market value and for for sale value. If I permit me to just give you background to that, like if you look at the power of the mortgagee, that is bank or the financial to whom mortgage the property is mortgaged, they have the power to sell, they have the power to foreclose. If you consider the two power, they have two different circumstances in them. The first power to sell, that is what we call implied power to sell, is always in deed of mortgage. That is a situation where the mortgagor has been defaulting and the power has matured to be exercised. In that case, foreclosure has not taken place. So the mortgagee will not have the privilege of reasonable time for negotiation of terms and conditions. It will be selling under distress, under time constraints. That will go for what? For sales value. Where the mortgagee has foreclosed, then he has extinguished the equity of redemption of the mortgagor. Then he opens to the sales of the property in the market without any limitation. Therefore, that will attract what we call open market value. Or in recent time now, we call it market value. They said it's a surplusage to put open markets there. That is the trend in international practice now. Market value. Just say market value instead of saying open market value. That the word open there is more or less like a surplusage that is not really necessarily needed. This is the provision of standard. Now, before I go further, so another issue I want to raise, let me quickly see what we have on the charts. Okay. I'm supposed to have about 7 and I've not read. I want to quickly see where I stopped. Okay, good. Okay, I think this guy is just greeting us and is asking which class is this. You know, he just came in. Just came in. That means she has been somewhere making money. You know, essence surveyors like to make money. Okay. And the other guy is saying, okay, the other guy responded. Thank you for that response. Another guy responded again. Thank you for that. Then I think there is this question. Difference between existing state and existing Zoom meeting. Okay. Very clear. Existing state is reflecting the condition of the asset in its present state, the way it appears, reflecting the condition of the asset. That is existing state. Existing use is in the business, current business where the asset is. You are talking of the value of that asset in the existing business, in the present business where the asset is committed. That business that the asset is committed to, you are looking at the value of that asset in that business. Right? It might be higher, it might be lesser than market value. It depends on a lot of factors that we have discussed earlier. Operational efficiency, for example, will affect that. Right? Issue of in utility will impact on it, either negatively or positively, and so on. Managerial competency can affect it. You know? So the value of that asset in the business where it is being used, value of the asset to the existing business, that is existing use. Value of the asset in its existing condition, in its present state condition, that is existing state. Okay, I think that's okay. Then somebody said differentiate between fair value and open market value. Okay, thank you. They are more or less the same. They are close. In fact, the body of knowledge has it that fair value and open market value are the same. However, fair value is peculiar. It's not the same. You cannot use fair value where you can always use market value. Fair value is peculiar to financial reporting. That is the language our clients, the stakeholders in the finance world, that's the language they coined. That's the language they understand. Right? But it equally has some coloration that can make it a little different from market value. For example, in fair value in some cases could be required to be decomposed. You decompose land and development thereon. You decompose them. Value decomposition, which is not in the case of market value. Because of the use of our value under financial reporting, that's why they call it fair value. It's actually the value that an asset will be traded for, or a liability will be exchanged. That again is analogous to our market value. But the peculiarity of it is that it's not being taken to the market for sale, right? It's being used for financial purpose. And the use for financial reporting purpose is not sales. Part of the use for financial reporting purpose is what we call carrying amount. Part of the use for financial reporting is for what we call impairment test. Part of the use for financial reporting is what we call allocation of prices. Part of the use for financial reporting is what we call assessment of depreciation. So if you look at all these uses, they are different from the use of what? Market value. So technically, they coin as what? Fair value. The word fair value therefore means what? Market value within the sphere or within the scope, using the eyes of financial reporting to see it, which therefore has some peculiarity in terms of the fact that it is not a market value because it's not transaction, it's not relating to transaction, it's not transaction driven. It is for some decisions and management activities, like having to allocate prices, having to assess depreciation, having to ensure what we call carrying amount. What is carrying amount under that standard is analogous to what we call book value. What you carry in your book, carrying amount. You can see where the difference comes in. So it's a peculiar terminology to financial reporting. Okay, and it has some intricacies, particularly in the aspect of having to do value decomposition. That is very, very specific to it. Okay, let me quickly see. I don't know if we are there. Okay, I've done that. Market value, I've done that. Okay, the advice, mute your microphone, mute your microphone, mute your microphone. Is this Ibrahim? I hope you have muted your microphone now. I've explained existing use and existing state, please. Still unclear, please. Wow, still unclear. Okay, let me see if I can bring up an analogy. Okay. Okay, it's not the same person. I hope this second person now was in the class. It's not that you were distracted when I was explaining, but let me explain again. Existing use and existing state. Existing use is looking at the value of the asset in an existing business. That means we are not looking at the value of the market in an open market, value of the asset in an open market. You are looking at the value of the asset in an existing business. What is its contribution? Given the state of the business, the performance of the business, what the business is doing, what value can you place on its asset? For example, such view will help you in the aspect of when you are talking about flotation of shares, for example. If you invest, if you have what we call red ocean principle, you just commit capital, you have a lot of sunk costs, and your performance is not encouraging. Nobody will pay substantially for your shares. You can see that is talking about the impulse of existing use. So existing use is value. Look at, okay, let me pick a plant. Okay, let's just pick a power generating plant, for example. We are familiar with that. Yeah. Existing use will be the value of that plant in contribution to the business where it is being used. Value that we can place on the plant, on the physical asset, based on the business where those assets are committed. Existing use. And I said that means what? Going concern value. Going concern. Now, existing state is what is the condition to reflect the condition, present status, present state, present condition of the asset. How old, for example? How old, for example? What is the state of repair? You know, reflecting what we call physical factor, under factor affecting plant and machinery value, machinery value that I discussed earlier. How old? What is the impact of use on it? What is the level of maintenance? All these come under existing states. To arrive at existing state by depreciating, bringing, imparting, having depreciation to appearing on the asset. Okay, so those are the two different places. I hope that is clear now. Still on. Okay, I've explained that. Then I can't get explanation because Ibrahim's sorry, madam. Ibrahim, this Ibrahim, please do. You have to be the right Ibrahim. I hope you have muted your microphone. Check. Okay, sorry, because I've not been hearing background noise here. Maybe my own speaker here is not on.
The Bluetooth device.
Oh, maybe I have it when I was going. No, I didn't. Okay, but check it out. Okay, so Mr.
Successfully.
Now, I appreciate that, Cynthia. I hope you have gotten it now. Okay, I've done that. Thanks. Okay, Ibrahim, thank you for doing that. Thank you for being your brother's keeper. Again, please, Ibrahim, you are. Then, please, I don't get that of market and fair value. Okay, you need me to explain market and fair value again. Okay, I said fair value mean more or less the same thing as market value, but it's a terminology that is peculiar to the finance world, and in the sense that it's a prescription or statement of financial reporting, and it's in our valuation standard. Now, it's what an asset can be exchanged for, what a liability can be traded, for in their plain language. But I said why it cannot be plain, where it has a connotative meaning, why we cannot say fair value is the same thing as market value. One, you cannot use fair value in all other areas where you will be using market value. Fair value is not for an asset for sale. Fair value is for financial reporting, where it is for management decisions, strategic planning. Fair value. And I said part of the nitty-gritty about fair value is that there are cases where, because it's fair value, you have to do value decomposition. For you to understand the need for that, do we have to go into valuation, international valuation reporting standard, international financial reporting standard, or even for international valuation standard too? You have to, I think IVS 300 talks about that, the need for that value decomposition. Market value, you don't decompose it, but we decompose in some cases, not in all cases, fair value because of the need of that valuation, right? One of the needs why it is a fair value, and one of the needs is allocation of depreciation. Let me give you the logic behind value decomposition. Allocation of depreciation is such that in the book, they want to allocate depreciation. What they want to write depreciation in respect of the property. If it's land and building, for example, they have observed that land and building are made up of, land and building is made up of two components: depreciable components and non-depreciable components. The structure on top depreciates, land does not depreciate. Hence, made for value decomposition, so that they can do proper allocation of what? Allocation of depreciation. That is the use, and that's why they don't call it what? Market value. So it is within the perspective of financial reporting that it's going to be market, it's going to be fair value. And it's fair value because the use is not truly market value. It's managerial decision, strategic planning, and things like that, where you have to allocate depreciation, for example, where you have to do carrying amount. As a carrying amount is as good as your book value, the amount you carry in your financial book. There you have to do impairment tests. There are conditions of impairment test. This is not financial reporting class, so I might not be taking you through all those ones, And then where you have to allocate prices. Okay, so these are the 4 uses of your fair value, which therefore make it not to be what? Exactly the same thing as market value. Market value represents the value of the asset in an arm's length transaction, in an hypothetical market. In an arm's length transaction, an hypothetical market, where there is reasonable period for negotiation of terms and conditions. Okay, so that is market value. I just give you the summary. So you can see the difference. When it is market value, for example, is usually transaction driven. There could be exchange. You are talking of purchase, for example, there will be exchange. You are talking of sales, there will be exchange. You are talking of mortgage, there will be exchange. Okay, so all these are what we call market value. But when it is fair value, it's usually for reporting so that management can take decision. There could be strategic plan, right? Analysis, ratio, financial analysis, and things like that. So they came up with the term fair value. But if you look at the definition of it and definition of market value, they mean the same thing. It's only that the use of fair value is different from the use of market value. So therefore, it's not in all places where you can use market value and you can use what? Fair value. Thank you. I hope that is clear now. Yes, clear now. Thank you, Cynthia. I appreciate that. Okay, Ibrahim said he has muted. Thanks, at Ibrahim. Somebody is thanking you. When value, I have another question. I want to go to another slide and let me quickly answer questions on what I've done so far. When valuing for going concern, does it mean you don't apply accrued depreciation? No, I didn't say that. When valuing for going concern is not the same thing as going concern is existing use, it's not reinstatement. And it does not mean you will not apply accrued depreciation. That's accrued depreciation more. Accrued depreciation it even goes accrued depreciation even goes beyond physical deterioration of curable depreciation, incurable depreciation. The accrued depreciation, when you are valuing for going concern, you look for all elements of loss in value, including functional obsolescence, economic obsolescence, technological obsolescence, inutility, under concern. Because there you want to see the value of that asset in the business. How is it contributing to the business? Is it active? Is there passive? Is there untapped potential of it? Are there some deficiencies in the use of it? Right? And things like that. So, and there you want to measure the streams of benefits accruing to the business because of the assets, which is what the people, whoever want to buy shares is interested in, right? Whoever want to match with the organization, that's what they are interested in. Whoever want to acquire that organization, that's what they are interested in. Okay? So, noble colleagues, you have to, I'm not saying you don't, no, I have never even ever said that. You have to reflect it. However, in reflecting it, that is when you are using what? Cost method. Cost method. You have other methods. You have, for example, income approach, otherwise called profit method, right? In plant and equipment. You have that one too. You can use that. In that situation, all this issue of accrued depreciation will not come up as a concept. The state of the performance of the business, the income of the business will reflect all those things. Okay? So, yeah, the other guy said, yes, Cynthia, thank you for that confirmation. Okay, I think I can now move on. Hello, sir, please, can we get the lecture slide for further studies? I think we have committed ourselves to that since our first class. Maybe you are not, you are a late comer, I will catch you. Tabansi, I catch you, you are a late comer. You just come, you came in late. That's why you didn't hear that one. So I have a late comer catcher. Okay, thank you. That will be done. Okay, at this point, let's quickly go to another slide, please. Let's go to another slide. And that another slide, we are opening up a new concept. Just discuss one or two other concepts before we go further into, another concept again. Okay, so here I have this. I have all like termed asset proprietorship. Asset proprietorship. This is very, very essential for us to know, right? In plant and equipment or plant and machinery valuation, you have different categories of assets. Among the assets that will constitute the plant and it can value and machinery. Now, I identified 3 categories among the assets of an organization. Proprietorship of assets can take any of the following forms. One, it could be that they own the assets. They bought, acquired the assets, so they own it. That is one. The second one, right? The second one, which is this, this one, it could be under financial lease. It could be under financial lease. And the third one is it could be under operating lease. It could be under operating lease. Now, noble colleagues, how do you treat all these assets? How do you treat all these assets? In the first instance, let's go to asset owned. Asset owned. When the organization owns the assets, there is no ambiguity about how the asset is to be treated in the valuation. It has to be captured, has to be recognized to the full details of the value of the asset. There's no limitation when the asset is owned. When the asset is owned. However, where the asset is on operating lease, where the asset is on operating lease, let's look at that. The asset is on operating lease, right? An asset on operating lease, which is this, on operating lease, is as good as an asset on what we call something similar to our tenancies or leases in land and building. It is an asset being held and being used for the time of the lease. Assets held and used for the time of the lease. For the time of the lease. But let me say for the term. That is to say term in an asset or an asset for a time. An asset for a time. If you look at this, right? If you look at this, right? That is a situation where whatever money that is paid by the lessee, money paid by the lessee, right? Under this, the money paid by the lessee for the use is for the use of the asset. It's for the use of the asset. It's for the use of the asset. That means money does not earn the lessee any right of ownership. It's right of possession, right to use that the person has, that the company will have when it is on operating lease. When it is on operating lease. That type of an asset is not to be included in your valuation. It's not to, even though it's, even let it be the old plants that they are using. When an asset is under operating lease, right, is not to be included in the valuation because it is not the asset of the company. What the company only has is the right to use for the time of the lease. Ownership will not be conferred on the company. That is operating lease. Now, what about the case of financial lease? What about the case of financial lease? Financial lease is a situation, right? Financial lease is a situation of close to what we call hire purchase. Okay? This is a situation where, you know, the acquisition of the asset is like on instrumental payments. Where payments made, right? Part of that payment will go for the use of the asset. Part of the payment will be equity contribution of the user. Equity, see my equity. Okay. Equity contribution of the company, right? Of the lessee. So it means invariably that under this case, right, the ownership lessee, this one is equity contribution. That means from year to year, the equity of the lessee will be increasing, right? While the equity of the lessor will be what? Decreasing. The equity of the lessor will be decreasing. It means at the end of the lease period, the ownership will eventually be what? Ownership will eventually be transferred. Ownership will eventually be transferred to the what? To the lessee. Transfer of ownership. This will involve transfer of ownership to the lessee. This involves transfer of ownership to the lessee at the end of the lease period. At the end of the lease period. Whereas in operating lease, there is no transfer of ownership. But in financial lease, there is transfer of ownership. Now, how do you treat assets under financial lease that will have transfer of ownership? Right? The normal standard is that this asset have to be captured in your valuation. By capturing it, we have to reflect the quantum of equity contribution. The quantum of equity contribution of the lessee. The quantum of equity contribution of the lessee. However, let me mention at this point that in the study pack, I noticed that the study pack says it has to be captured in full. I've not seen that under international best practice. Of course, as at the time of valuation, let's take for example that there is a plant that works, let's say 100 million. And there is a lease period of 10 years, right? And 3 years after entering into the lease period, you have the asset. Let's say it was 100 million, they are contributing every year 30 million, so to say. Take down 10 million to be inclusive of their profit and everything. So after 3 years, your firm is to value that asset, right? Your firm is to value the asset after 3 years into the lease. The lessee, which is the entity, the organization you are valuing for, has only contributed, you know, what? 30 million. Right? There is no any rational grant for the full asset, the full value of the 100 million to be captured in the valuation. The full value of 100 million to be captured in the valuation. Because as at the date of that valuation, there is a part owner. The entity is a part owner to the tune of 30 million. The lessor is a part owner to the tune of what? 100 million. Right? I mean, sorry, to the tune of 70 million. So in these circumstances, the whole equity of 100 million cannot be vested or allocated to the entity that the value is being done for. Okay? So that will not reflect the true state of the proprietorship. Okay. So that is an observation I need to make there. Now, but the summary is that you will capture the value of the assets on financial lease. Any asset on financial lease, the value will be captured. The only area of argument is that it has to be to the quantum of the contribution. That is what the equity, the share of equity of the lessee, who is the client, who is the entity or company you are valuing for. Whereas, if it is owned, it has to be captured fully. It's an asset owned. If it's an operating lease, it will not be captured at all because it does not belong to them. It's just the usage that they have. So that is that about asset on operating lease, asset on financial lease, and asset being owned. All these categories of assets are assets you will find within the portfolio or asset stock of an organization. If you find them, then you know how to treat them. Then I've used this to equally explain what is financial lease and what is operating lease. So if you have to differentiate between the two, you know what to write. Or if you have to explain what they are, you know what to write. And if you in valuation practice, you have to demonstrate your knowledge about the two. You know how to treat them in your valuation exercise. Okay? So that is that about this. At this point, okay, I don't have any chat. So let's go to another slide. Again, we are opening up another issue. We are opening up another issue. So again, this is two other conceptual issues that we should know. Two other conceptual issues that we should know. And they are very, very important. Please, it's not enough for you to be able to explain. It's enough for you. It's equally important for you to know what they mean and to know how to reflect them in your calculation. Because they'll be featuring as we proceed, particularly into methods of valuation. Now, understanding current reproduction and current replacement costs. So there is difference between current reproduction costs and the current replacement costs. So this slide and the next slide is explaining the difference between the two. It's explaining the difference between the two. It's not a matter of nomenclature or choice of words. They are technical terms, and we must know what they represent. Just like in the case of talking about scrap value and salvage value. We use scrap value and salvage value interchangeably, but they don't mean the same. When we get to that topic, we will treat it. Okay? So, in this case, current reproduction costs, or let me just explain. Okay, somebody is saying I should please repeat financial lease. Okay, no problem. Financial lease, let's go back. Financial lease is a lease arrangement where payment for effectual transfer of ownership is made instrumentally. The payment by the lessee represents partly for the use of the asset and partly equity contribution towards the eventual ownership of the assets. And therefore, it means that at the end of the lease period, without default on the part of the lessee, right, the ownership of the asset will be transferred to the lessee. It moves from the lessor. Okay? It then equally means that during the lease period, there are part ownership. The lessee owns a part to the extent of its equity contribution. The lessor owns a part to the extent of the remaining equity that he has. So that means the payment made, periodic payment made under financial lease. Financial lease is an arrangement where the periodic payment is for acquisition of the assets as an instrumental payment, in which case at the end of the lease period, the ownership will be transferred to the lessee. And that means as year increases, year in, year out, equity of the lessee will be increasing, equity of the lessor will be what? Will be decreasing. At the beginning of the lease, equity of the lessor will be they will be at the highest. The lessee might be 0. But as year increase, year 1, year 2, the lessee is contributing his own equity. And the contribution is making will be reducing the equity of the lessor until the equity of the lessor will tend to 0, and therefore assets will be transferred to the lessee. That is, ownership will be transferred to the lessee. So that is financial lease. But when it is operating lease, the payment is in lieu for being in possession of the asset, for using the asset. No eventual transfer of ownership. So it's an asset for a period of time, for a time, just using it for a time. For a time covered by the payment made. That is close to the rent you pay. That's close to the tenancies and leases we do. There are no eventual transfer of ownership. Okay, so that is that. Thank you. Let's go to this slide now, where I want to talk about where I go. Okay, thank you, Alima. Thank you for the explanation again. Thank you. I have Joshua saying thank you. I appreciate you. Thank you. Okay, so we can move on to this slide now. Now, in this slide, I have 2 concepts, and I said we have to explain. I have 2 concepts that I said we have to explain. One of the concepts is concept of reproduction costs. The second one is replacement costs. I said you see them often in valuation, or or in plant and machinery valuation in report, but they are not to be used interchangeably. They have specific meaning. They have specific meaning. So let's see current reproduction costs. I said current reproduction costs represents the present costs. That's the word current there. What is obtainable in the market now in terms of the price or cost of the assets you want to value. That is the plain language. Noble colleagues, the particular asset, the particular plant, the particular machine or equipment that you have to value, what is it going for now in the market? That particular asset, the same type of asset, that is reproduction cost. Where you are able to get that figure, you want to value an asset, for example, a plant, and you do your market referencing, you realize that that plant is still available in the market for sale. You obtain the price of that same type of model, that same type of asset. Then you are dealing with current reproduction cost.
I can't hear.
You can't hear me? Is your network now? Even the way you are talking. Are you hearing me now? I want to take it that you are hearing me now.
Most of us are hearing you. Probably his network from his end.
Okay, thank you. Okay, please, Oga, if you are hearing, adjust your network. Invariably, don't use mobile network. If you use Wi-Fi, the better. Okay, so now, background noise, please. You have to mute yourself. Background noise. Who is this? Okay, Oga, you just come with me now. Mute yourself now. Thank you for that comment. Abubakar, you mute yourself. Mute yourself. Okay, thank you. You have done that. I appreciate that. Thank you. Now, so if in the market, the same type of machine or equipment or plant you want to value is still available, so that you can obtain the price of it or the cost of it, what is being sold for now, that is reproduction cost. Apple for apple. Same, not same like, not the like. Are we together? Same, apple for apple. Right? Then that is the production cost. The fact that obtaining needs in the present market that will be of a new asset now, that makes it current reproduction cost. Current reproduction cost. Reproduction cost is the cost of the same type of asset that you can obtain. It's still available in the market, you can obtain it. It is a current reproduction cost because it is an existing market. What is going for at the time of your valuation, that makes it current reproduction cost. When all other costs of installation, transportation, freight, import duty, commissioning, installation, base structure, and everything that has to make it to be installed and ready for use, to be an asset in place and ready for use. You know, when you buy a plant, it's not yet ready for use. It will not start contributing into the business. It has to be imported if it is from abroad. You have to pay freight. Loading and offloading will be there. You pay import duty. There will be local transportation to move it from the sea to wherever part of the country. There will be installation charges. There can be licensing charges. There can equally even be, in fact, there can be monetary charges. Okay, royal fathers charges can come in. Anyway, that's the peculiarity about Nigeria when you are doing development. You want to install a plant, you need the plant come like this. Before you get to your factory, a lot of vehicles have followed you. They are problems. They want to collect their own shares. They contribute to cost of installation. So your installation costs, your commissioning costs, when you add everything together, which means you have taken the asset to be on site, installed, and ready to start performing, right? Then you now have what we call gross current reproduction cost. Please note those languages. And I said the gross current reproduction cost is what we call installed cost new. But your current reproduction cost is called cost new of an asset. Cost new. When you have added all other costs that will take it to your site, right from where it's bought, take it to your site and get it installed, ready for use, it becomes installed cost new. Right? Gross current reproduction cost is what we call installed cost new. That is current reproduction cost plus all other associated costs before you can get installed and ready for use. Okay? So I think this is simple enough for us to understand what reproduction. See, the major concept there is reproduction. Let me show you. The major concept here that you must know is what? Reproduction. My friend. Yes. Is this. This is the major thing. Reproduction. That's the difference. Reproduction and replacement. Reproduction is that asset, the typical asset, the same type of asset, not the like of the asset. Please. Okay? It's current because you now have that information, market information on it, cost information from the market, existing market, present market, on new one, same type of asset. It becomes gross current reproduction cost when all other costs, freight, transport, loading, offloading, import duties, installation, commissioning, licensing, and all sorts of have been added to your current reproduction cost. And it becomes gross current reproduction cost, which is otherwise called what? Installed cost. Thank you. Let's go to the next slide. Let's go to the next slide. You can see that these next slides share the same view as the first one, because they are more or less, you know, like as people will say, two sides of the same coin, and they don't mean exactly the same thing. Sorry, I'll come to the chart. Now let me quickly explain this, and I come to the chart before I go to my final and last topic. Okay. Now, current replacement cost. The only difference between current replacement cost and current reproduction cost that I've explained before is what? The replacement. What makes the replacement cost? Cost of an equivalent asset. Please note that too. Cost of an equivalent asset. Cost of a closed substitute. Cost of an asset that can render the same utility, the same satisfaction as the one you are valuing. When that is what you obtain in the market, then it's what? A replacement cost, current replacement cost. You've not been able to see the exact type of your model, exact type of machine or equipment you want to buy, but you see a close substitute, an asset of equivalent utility, asset that can render the same utility, even though it's not gold for gold. It's not the same asset. You only see similar asset that is of close substitute, that is of equivalent use, that can render the same utility, right? The same satisfaction. Then that is termed current replacement cost. That is termed current replacement cost. And I said this simply means cost new of an equivalent or substitute asset. Cost new of equivalent or substitute asset. Again, when all other associated costs, right? All other associated costs in terms of freight, loading, offloading, freight, transportation, installation, import duty, like that, all other costs as I mentioned earlier, where they are now added to the cost of the plant or equipment, right? To make it an asset in place and ready for use, start to perform, start to yield utility. Hence, it becomes what? Gross current replacement cost. Noble colleagues, don't forget, these are the two differences. Now, okay, don't worry. Please master these two costs concepts. When we get to depreciation and obsolescence, particularly obsolescence, we'll be relating them to see, how they affect the indication of obsolescence. In some cases where you can have obsolescence, in some cases where you can never have it, we'll be discussing about them. And when we get to methods, particularly on that cost, we'll be discussing about, okay, one model of cost method will give you this and so forth. So please try and assimilate, understand the two concepts very well. As you know the back of your palm, the back of your hand, and you'll be able to explain to what? To a grammar. To a grammar, current reproduction cost is this. Grammar, current replacement cost is this, and grammar we understand. So with that, it will flow in your brain. When we are now applying them in obsolescences and when we are talking about them in methods and things like that, it will not be strange to us. And beside that, you can equally have them under right short notes or distinguish between the following or explain the following and so on and so forth. All this is supposed to be bonus marks for you. Okay? So as we proceed, I think we are adding up, we are getting this thing becoming more refreshing. We are adding up to our knowledge, gradually, because Niesv have said they want everybody to pass this exam. And I think you will not be an exception. And everyone here, they are ready to pass. So you have to give it your time. You have to give it the time that is required, the mindset that is required, and don't say it's foundation. Foundation, almighty foundation. There's nothing almighty about it. It's just decision to know, and so you will know. Now, again, gross current replacement cost is equally a form of what we call installed cost new. It's equally a type of what we call is an installed cost, just like gross current reproduction cost. Gross current replacement cost is termed installed cost new. That is the cost of the asset after purchase, getting it to the premises of the company, getting it installed, and when it is ready for use as at new state. At new state. Okay. Thank you. At this point, before I hit the last two slides, which will be on my final slide for the day. The last two slides, they are two. The two slides is just on one topic, one concept, and very critical concept. Very, very critical. which you cannot afford to miss, because I doubt if you will not have it in your exam. It's usual. It's a huge, very, very usual. The probability of having what that the two slides is are all about is very, very high. So let me see. I think I have about 4 more comments. 4 more comments. Okay, okay. Thank you. So thank you so much too. I appreciate. We can hear you, sir. Thank you. That is responding to that. God bless you, sir. God bless you too. I appreciate you. Okay, that's all right. I don't have questions. Okay, I appreciate that. Let's go to the last 2 slides. Because these last 2 slides, we have exercise to do. All of you will do exercise before you go. There's no shortcut about that. You do your exercise. As you do your exercise, if you are fast enough to post your exercise to my WhatsApp, I will open it and I will display it. We can run through it to see if there is or I just open it and pass my comments to you. Okay? It's only that this was observed. I hope you will not be tired. Or the full memory. Okay, no problem. So let's quickly see the last 2 slides. What is all about this last 2 slides? All of you must have been hearing about what we call condition of average clause. Condition of average clause. This is common in Niesv exam. So the last part of our discussion will be on condition of average clause. I do hope that we'll be able to finish these 2 slides, even though there are 2 slides. Okay, let's continue to run. Okay, what is condition of average clause? It's common that Niesv normally answer that question. Explain condition of average clause or explain average clause. It means the same thing. When they say condition of average clause, what makes it a condition is that it is usually a clause within the terms and conditions of insurance policy. It's usually a clause. That is not the definition. That's not the meaning. I'm only telling you why in some books or materials, or why I put it as condition of average clause. It's usually a clause within the terms and conditions of insurance policy. Now, what this clause is all about, please, I have the definition, explanation about it, right? Now, what the clause is all about is all about under insurance. This clause, noble colleagues, all candidates in attendance, please note and tell others to note, is not applicable to a case of over insurance. Because there are these tricks that I see in your questions, that they will trick you, they will give you case of under insurance, they'll not give you another case of over insurance. And candidate, if you just rush to apply condition of average clause to over insurance, you are in the bush, off the bar. So it's not applicable to case of over insurance. It's applicable to what? Case of under insurance, right? And it is used to determine settlements that the insured will be entitled to in case of any eventuality. It is used to determine settlements that the case will be entitled to in case of any eventualities. Okay, now, what does it mean? Condition of average clause is an expression of the condition that in case of any under insurance, the insurer, which is the company that insured another organization, the insurer will only be liable to the proportion of loss, based on the contribution. And whatever difference in the law will be borne by the insured. Whatever difference in the laws will be borne by the insured. What it means, let me explain, is that here there is under insurance. Because of under insurance, and there has been a loss sustained and agreed upon, it does not make the insurer or insurance company to be fully liable to pay full settlement for the loss. Why? Because there is case of under insurance. They will invoke this clause, and what they will now do is that they will pay proportion of that loss. determine the proportion of the loss is to relate the value upon which premium is being paid, which we call the insured value. That value will be related to the value at risk, which is the market value of the asset. I will show you. So where that happens, they will just pay that proportion, right? Will be paid. It means the what will be paid will therefore be what? Be lesser than the agreed loss. Settlement will not be up to agreed loss. Hence, deficit in loss, which is the difference between agreed loss and settlement, is the insured that will bear that loss. And this varies in his language. This is one expression that I so much like. He said the insured will therefore be the insurer of that deficit in loss. Because of what? Because of case of under insurance. So I have it in this slide. I said average clause is applicable to insurance and determines the claim to which an insured will be entitled to in the case of any eventuality. It expresses the claim to be settled by the insurer out of any loss as a proportion of value insured and what? Value at risk. Value insured is the value upon which premium is being paid. Value at risk is the market value of the asset. It takes effect in the case of under insurance. That is, there can be undervaluation of the value insured. It's not only undervaluation that can cause it, but where you see under insurance, I will give you clue on circumstances that can be under insurance now. By implication, the insurer will then be left to be the insurer of the remaining or outstanding loss. That's what it says. The insured will be the insurer of the deficit. Okay. Now, what could contribute to under insurance? One, maybe the valuation, there is undervaluation. Two, maybe there is understatement of value for insurance, I think insured value, by agreement between the parties. Agreement between the parties, that is between the insured and the insurance agents. An asset worth 100 million, they say, no, I don't want to insure you more than 50. It's better if you can do 70, okay, let's do 70. You know, there is already a case of under insurance here. Or maybe because of what? Shift in value. Insurance valuation is supposed to be done periodically, at reasonable interval, because of the fact that value is not stagnant. An asset that is valued 3 or 4 years ago, at let's say for a figure of 100 million, can be worth more than that today, because of what? The dynamism in the market and in our society. So if that asset has not been valued, revalued, and means the same as declared 3-5 years ago, there will be incidents of under insurance. So when you have the case of under insurance, the insured, they have to bear the loss, the deficit in loss, because the insurer will only pay a portion of the insured value and that of this value at risk. Now let's quickly see that first, before I will now explain again another side to it, which is the side of even when there is over insurance, where the condition of average clause is not applicable, insured equally loses again. Somebody, Juliana Oladeko, please move your microphone. Juliana Oladeko, move your microphone, please. The noise is too much. Juliana, that means you are not in this class. You have not been okay. You have not been able to move. Oh, you have not been able to move. Since you are just put on, just hang on to the class, not concentrate. You are not hearing me. Juliana Oladeko. I don't know if I can move to the person. Okay, I think maybe she has voted herself. Okay, let's proceed. Okay, I quickly mentioned that in event of over insurance, even though average clause is not applicable. The insured we equally lose. How? Because you will be paying premium, excess premium, out of which you will not benefit anything, you will not derive any gain from it. You will not pay him more than the loss sustained and agreed. You will not say because the value, the insured value has been more than value at risk, so we will pay you excess. No insurance company will do that. So that means he has been paying excess premium for what? For nothing. For nothing. That's the case of most cases where there can be problem of misplacement of concept of value. I've witnessed a case. This one in terms of land and building, portfolio of an investor wanted to insure. He had even insured. They now sent the list of his asset with insurance value, so to say, the insured value to me as reviewed. So when I saw it, I said, and we carried out the market value of the asset just a couple of months before the time. So I noticed that what they put there was actually market value, not insurance value. You can see that's a case where the guy would have been paying money on market value rather than insurance value. And you and I know that in case of land and building, particularly property in prime locations, insurance value will not likely be up to market value. Why? Because land value will not be part of the insurance value. Land value will not be part of it. And if you look at what will be the value of land in a very prime market, it might really be significant. So anyway, I've explained average clause. You now know what it means. So how do you now apply average clause? How do you apply average clause? And if you have calculation question, so let's quickly see the formula. So that is what we have here. The formula, that's what we have here. Okay? Oladepo, you have started again. No? Oladepo, Juliana. Oh God. Okay? So now, that's what we have here. We have the formula. This formula can be rewritten in any form. The host, can you move this up? Put her in. If you can move her, please. Can you put her in? Host, can you put Juliana Oladepo in waiting, or you move her? If you can, okay. If you cannot move her, please put her in waiting room for us. So when she's ready, she will let us know. Then let her comply before you add her. Thank you. Okay, so let's proceed, please. Now, this formula I said can be written anyhow, okay? But I have written it this way, and I think it's simple enough. This is a value at risk. Insured value multiplied by loss sustained all over value at risk. That is the current value of the asset. Now, let me quickly tell us that this can be rewritten. Let's see, let me open up another slide so that I can rewrite that. I want to rewrite this so that we can quickly see a difference. Meaning the same thing anyway. It's just simple arithmetic. So whichever one you find for most convenient for you, you use. Okay. So here now. Okay. So this formula, right? Instead of writing it this way, we can actually write it, get the proportion of value at risk, and the proportion of the the proportion of the insured value and value at risk. Okay. we'll get that. So here we have our insured value. Insured value divided by what happened? Where is this one coming from? Okay. I have some interference there. Okay, let's just proceed. This is not distorting. I want to clear. Okay, don't worry, so that I don't waste your time. Let's do this. I'm trying to, that's this mark that came from here. You know, I'm trying to get rid of them, but it's okay. Let me go back. Or maybe I should select.
So we can continue. The line is not obstructing anything, sir.
It's not obstructing, okay.
It's not obstructing anything. We can continue, sir. We can proceed.
It's okay. Okay, so I go back to my pen. So now we now have an insured value all over value at risk. Value at risk. This will be a fraction multiplied by loss of 10. Okay, so you now have this. So this what we have here is the fraction and the proportion. So this insured value is the figure for the insurance. This is value at risk, which represent market value. This is the agreed loss. You know, they have assessed it, they agree at a particular loss. So if the insured value, this clause and this calculation will only be applicable in a situation where there is case of underinsurance, where insured value is lesser than your value at risk. Okay, so let's quickly see that slide. I have an example, and I want to give you a work example before I round up. Now, the example here, I says consider the valuation or insurance of a machine at a sum of 4.5 million. Right? Part damaged by fire was assessed to be 3 million. The market value of the machine is noted as 6 million. What will be the settlements? What will be the settlements? So in this case, you will now apply that clause. If you look at the question, that example, there is what? There is clear case of under insurance. If you look at it, there is clear case of under insurance, right? There is clear case of under insurance because the insured value is 4.5. Value at risk is 6.0. So you have a deficit already. So what you just do is, depending on which one you are using, you can just say 4.5. You write it in millions, please. When attending valuation question, don't write 4.5 MO. Write it in full, the way you see me doing, over 6 million. Okay, then multiply by the loss sustained, which is 3 million now. Okay, multiply by the loss sustained. That is the same thing as what we have demonstrated. 4.5 multiplied by 3 million divided by 6 million. So it gives us a value of a settlement of 2.250. The loss is 3 million. That means the insurer will take care of what? 750 on its own. Now, but let me do a corollary or a reverse of this. Assuming the insured value, please, assuming the insured value happen to be 7 million, then you should know that this clause is not applicable. If you have a question A says explain average loss. Question B says an asset has been insured for 4.5, value at risk or market value, current market value is 6 million, loss sustained or agreed is 3 million. Right? What will be the settlements? Then you will apply this. There is case of underinsurance. If the question C now says, in question B above, assuming the insured value were to be 7 million, what will be the settlements? You don't have any calculation there because case of underinsurance is not there. So average clause is not applicable. You will just declare the loss sustained and agreed as the settlements. No calculation. You just declare the loss sustained and agreed as the settlements. No calculation. So please note this, it's very important. Now, before I leave this one and give you maybe an example to quickly work for me, another style of Niesv is to give you other data that you don't need. You can put other data that you won't need in your calculation. Your question. So you should know the data that are relevant and those data that are not what? That are not relevant. Please, very, very important. Pay attention to those ones. Okay? Again, at this point, I've come to the end of the application of average clause. So can you please write this question? Let me dictate this question so that you quickly do it for me. You quickly do it for me. If you can do it before I attend to charts, available charts I want to run through now. If you can do it before I attend to them finish, you can let us have it. Or you just unmute yourself and tell us what you have done so that you don't load my WhatsApp with
sir, quick one, sir. I do not get that your last statement on if it's been assumed that it's 7 million, sir. I don't know if you can explain, sir.
Okay, thank you. If the value at risk, which is market value, is 6 million, as in the case of this example, they now said, assuming the insured value of the asset is insured for 7 million. The question is now asking you what will be the settlement. I said condition of average clause is not applicable to that case because it's not a case of underinsurance. There is no indication of underinsurance there. It's rather a case of what? Overinsurance. And in overinsurance, insurance company will not pay you more than your loss that you sustain. So it's not that they say because you have been paying excess premium or a higher premium, so they pay you more than the loss you sustain. No. So there is no calculation. It does not involve any application of any fraction or proportion as we have done. The formula we have shown is not applicable because average clause is not applicable to a case of insurance. I therefore said that the settlement will therefore be what? The same figure as the loss sustained and agreed. The same figure as the loss sustained and agreed. In the case of this question, it will not be what? 3 million. You just state it and you state reason. Reason being that what? Condition of average clause is not applicable to case of over insurance. I hope that is clear. Okay, please, can you please write this down? Please write this down. I'm not a fast typing person. I would have said I should type in your chat, but it's okay. Write it down. I can dictate. An asset insured by XYZ insurance company is recently damaged. Partly damaged by fire. Is recently partly damaged by fire. The loss resulting from the fire incidents have been agreed at 11 million. The assets, the insurance cover on the assets is at a value of 50 million. The asset is currently being sold in the market for 75 million. What will be the settlement? Determine the settlement. That is one. Number two.
Please come again, sir.
Okay.
Repeat the question.
Okay. Please listen very well. You know I'm dictating. I don't have anything that here. I said XYZ insured an asset which is recently partly burned down by fire. Recently partly affected by fire hazard. The loss sustained have been agreed at, I think I said 11 million. At 11 million. 11 million. The insurance cover has been at the value of 50 million. The asset is presently being sold in the market for 75 million. What will be the insured value? What will be the insured value? Number two, another question, please. ABC breweries with a modern plant. ABC breweries with a modern plant insured the plant 5 years ago. Insured the plant 5 years ago. At its current market price, then when it was bought. At its current market price, then when it was bought and installed. In the sum of 500 million. In the sum of 500 million. A fire incident, a recent fire incident affected a part of the plant. 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 And the loss sustained is estimated to be to the sum of 150 million. It's estimated to be and agreed to be in the sum of 150 million. Estimated and agreed to be in the sum of 150 million. Inflation in the market on the basket of goods of the plants since 5 years ago averaged 4%. Inflation in the market of basket of goods of the plants since 5 years ago averaged 4%. One, determine the value at risk as at date. One, determine the value at risk as at date. Two, what will be the settlement for the loss sustained? What will be the settlement for the loss sustained? Three, had it been that inflation had been at 0%, had it been that inflation had been at 0% in the last 5 years, what will be the settlements for the loss sustained? What will be the settlements for the loss sustained? Okay, on this note, let me quickly run through what we have. I don't know if this question. Okay, please move to your microphone, okay? Please move to your microphone. I do not get your last statement. I think that's the guy that said I should explain. I've explained. Okay. In this case, somebody is saying 7.3. I don't understand 7.3 here. Okay, that's the calculation. Right? Is it 7.3? Okay, another person is saying 7.3, 7.33. That's my first question, right? And what did you do? Who is this person? Folashe, please unmute your microphone. Tell us what you. No. Okay, who is this? The first person that sent it. Is it Dynamic or so? The first person?
That's Adeyinka. Sorry.
Pardon?
Adeyinka. Good afternoon, sir. Yes, sir.
I think you should change your name so that we can call it properly. Tell us what you did, please.
I used the insurance cover of 50 million and divided it by 75, which was the current market value. Yeah. Then I multiplied by the agreed insurance to be paid, which is 11 million.
Agreed loss.
Agreed loss.
Okay.
Then I got 7.3 million.
That's correct. That's the settlement, and that's what is to be paid. Okay.
Yes, sir.
That's settlement. That's
for
correct.
The second one.
Okay, second one.
For the second one, I got 480 million as your first question. I'm not sure whether I'm right or wrong. I just.
480
you said
million.
the value. Yeah, the value of the current value at 4% inflation rate over 5 years.
Wait to what in 5 years? 5 years ago, what was the current value of the plant?
It was 500 million.
So you are wrong. It can't be less than 480.
You said inflation affected it. Okay,
inflation.
It increased it. Oh, I'm sorry. I reduced it. Sorry.
Okay, so please go ahead, Adeyinka. And
so that'll be 500 times 1.04.
Okay, do your calculation and tell me. Do your calculation and tell me what you have done. And I want to hear from any other person. Please, any other person. Sir, my network couldn't allow me get the second question. You have to get the second question. Folashade. Folashade Ojolele.
No, I'm not the one that typed that one. No.
You are not. Okay, this is another Folashade one. Or what?
I'm still working it.
Okay.
I have not answered. question.
Oh, this is golden.
Please, it's me. It's not for Lashade. This is golden.
It's not.
Yes,
It's
sir.
not. I can see. Sorry. This is golden. Saying golden something. Okay. My second question. Can I repeat those figures? Well, in my second question, I said ABC buildings acquired a modern plant 5 years ago. They insured that plant at the current price of the plant then, and that was 500 million, right? And that recently there is a fire incident that affected a part of the plant, and the affected part and loss sustained has been agreed at 130 million. And I've said that inflation since 5 years ago had been at average inflation for the same basket of goods of that plant as average 4%, you know, as average 4% per annum. Since 5 years ago. Now, the first question is, what is the value at risk? Second question is, what will be the settlements to be paid? Third question is, assuming inflation has averaged 0% since 5 years ago, it's 0% per annum since five years ago, what will be the settlements? Okay. Somebody, I think you guys saying 520. 520. I don't think you are right. I don't think you are right. Adenika, what did you do? Can you quickly talk?
Yes, sir. At first, I think you said it was averaged over the 5-year period, but now I think you're saying every per annum. I used 4% as an average.
When I say average, that means per annum.
Yes, sir. So that's how I got it wrong. I used average over the 5 years. Sorry.
No. It's not some. Average. That means year in, year out, when you find the average is 4, you can say it's 4%.
Yes,
every year.
I'll recalculate.
Okay, quickly. Then somebody is giving me 600 million. That is Debo Adija. No. Okay, can you please unmute yourself and let us know what did you do?
Hello.
Hello,
sir. Can you hear me, sir?
Yes, very well. Go ahead, sir. Go ahead, sir.
For 5
We are not hearing you anymore.
years.
We are not hearing you.
And that's for 5 years.
You did what? Hello? Or you want to put it in the chat? If you can't talk to us, put it in the chat.
Hello.
Yes, I'm hearing you now.
Can you hear me now?
Yes, better.
Wow. Maybe my network.
We can hear you now.
Okay, so I said inflation rate is 5%, I mean 4% per annum, 5 years. I just did a straight line, and then that would.
Hello? Yeah, network is bad. It's bad. Sir, please, my battery couldn't allow me, didn't get the question.
Okay, so it will be 500 times 0.2 now, having increased 20% over the last 5 years as a result of inflation in value. So the current value will be 500 times.
That will not be right.
Okay.
Yes. You have neglected one important thing. What you have done is simple interest. You have neglected
year on year, right? Yes, that's why I said I used the straight line. So maybe year on year. Okay.
Yeah, you have to make sure.
Okay, I get you. Yes, I get you now. Compound, yeah. Okay. Thank you, sir.
Any other one? I have to close this class, so we have overstayed. Please. I want to take it that each and every one of us can do the question. Please, any one of us should type that question in the chat for people that have disadvantage of getting to us to see it. And I think I'm not hearing you. I have to end this class now. By the grace of God, I think my next class will be Thursday, if my memory serves me well. Okay.
No, it's tomorrow. It's tomorrow.
Is it tomorrow?
Yes.
Are you sure?
Tomorrow by 2.
No.
Yes, it's tomorrow, sir.
It's tomorrow.
That's plant and beauty. That cannot be plant and machinery. This is plant and machinery. Okay.
Okay, valuation. Yeah, valuation.
And valuation, land and building is tomorrow. It might be tomorrow. I'm not sure. And my own is Thursday in the morning.
Okay. Yeah, it's true.
And plant and machinery.
So please solve the question.
Sir, please, can we please have the correction to the question on Thursday morning by God's grace?
No problem, by the grace of God, no problem.
Okay, may Almighty spare our life till then.
Amen. Okay. I want to thank each and every one of you. Yes.
Please click on how to solve it. Please.
Okay, let me just explain that when we open up on Thursday by the grace of God, if there is nobody that will be able to do and send to me, I will call on board to come and explain to others. That's part of my own strategies anyway. It will teach others learn twice. So if you want to learn twice, solve the problem and come on board to teach others, so that you get to learn twice and assimilate. Okay, but the process is simple, right? You have 5 years ago, the insurance was done on the current price. But inflation had not been stable. It has been at an average of 4%. If it's not average, it will call for cost trending. I have not taught you, I have not mentioned that. So I won't go to that. But it's part of your basic knowledge to understand compounding in valuation using the formula of amount of 1 naira as simply put. Or you can work from first principle. Okay? When we say inflation is at 4%, that means the price of 500 million 5 years ago will not be 500 million today again, right? It has been increasing year in year at the rate of what? 4%. Inflation, if you are using amount of 1 naira table, for example, formula, you just subject it to 1 plus I raised to power n. Your I there will be 4%, your n there will be 5. Then that will give you what will be the current price, the value at risk. Otherwise, if you cannot use that formula directly, like what Mr. Debo Adejana mentioned, you can work from first principle. In year 1, add 4% to your 500,000. Whatever that figure is, charge 4% on it again for year 2. But you had it up. Whatever that figure is again, charge 4% on it again. You will not be charging 4,500. 2% on 500 for year 1. Whatever you get, you add it to that 500. It becomes principal in year 2. You charge 4% on that principal in year 2, add it to whatever it is. It becomes principal in year 3, like that, up to 5 years. We get the same thing. Okay? So, but the shortest and fastest way to do it is use amount of 1 naira table. Your formula, 500,000 into 1.04 raised to power 3. That will give you what the, excuse me, I think that solves that. That will give you your value at risk. With that, we'll now see that what was an adequate insurance cover, 5 years ago, today, there will be a case of what? Under insurance. Without under insurance, therefore, there will be what? Condition of average cost that will play out. So 500 million against whatever value that is at risk now, multiplied by the loss sustained, which is what? Which is 130. Then you get that figure as a settlement. That is question 2 now. The question 3 says, assuming there is no inflation. That's what that means. 0%, no inflation. That means the value of 500 million then as current, which is adequate for insurance cover, will still be adequate now. So there won't be case of what? Under insurance. And there is no case of under insurance, average loss will not be applicable. Even if you apply it, you get the same loss back as your settlement. So, and on that note, your settlement will be the same as what value, agreed, loss of sale and agreed. That would be the same thing, which would what? 130 million. Thank you so much, ladies and gentlemen, noble colleagues. It has been a wonderful period interacting with you on plant and machinery valuation. I do hope to come your way once again by the grace of God on Thursday, when we'll continue our discussion. I think that time we might be entering aspect of depreciations and the like. So let's get ready. Thanks so much. Have a wonderful evening. Bye-bye.
Thank you, sir. Thank you, sir.
Thank you.
Thank you, sir.